I am Dave Boswell. I work for Main Street Home Loans going back 7 years, but the ownership been with me. I've been with them for 3 decades, so over 30 years, serving families from Virginia to Maryland to North Carolina to Florida. You name it. We have done some good work along the way, and I always love to do these first-time home buyer classes because this is an exciting time for you guys that are on today and learning about how to buy your first home. Maybe you know someone who's bought a home, you have family that's bought a home, friends that have bought a home or are thinking about buying a home. So what you learned today, please pass it on. And ultimately, I want to be there for you when the time comes to get started on looking at the options and understanding what's particular to your situation. So let's go ahead and talk about the masterclass agenda. We're going to cover the home buying process. Going to do a little overview of that and all that it involves in getting your loan to the final stage where you get the keys to your new home. So we'll talk about that. We'll talk about loan options and specifically some options for first-time home buyers, grant programs, state-run bond programs, things of that nature. And then we'll talk about the 3 qualification pillars: credit, income, assets, what we do to qualify you. And then I'm not talking about hidden costs that I'm going to hide from you. I'm talking about hidden costs that you may not be thinking about. So we're going to talk about those things to make sure that when you're doing your planning, when you're doing your budgeting, you're going to be setting yourself up for success. And then we're going to talk about the difference between just focusing on a monthly payment versus really what's important. Cash is king, liquidity. How do you balance a good payment with maintaining more liquidity for other things in life? We'll talk about rates. I don't want to spend too much time on that, but it's good for you to understand the drivers and what rates are doing. I will give you somewhat of a prediction that I'm hearing from experts in the industry. Some of it's my personal opinion, but we'll talk about that. And then we'll walk through some strategic examples of down payment, closing costs, payment, and how that kind of affects you in terms of your long-term financial wellness. So let's go ahead and jump in the first section here. We're going to talk, let me flip the slide here. We're going to talk about just a very high overview of the purchase process. You're currently right now in the preparation and strategy stage. The biggest mistake that most new buyers make is they start at number 3. It's an emotional thing. I get it. And you want to be able to go out and look at homes and get a sense as to what's out there. But doing it that way could set you up for a little bit of failure and a little bit of disappointment, because if you don't start at 1 and talk about preparation, talk about what's important to you financially, you may not otherwise have afforded the house that you were looking at, or it was out of your reach, or it's not something you should reach for yet. So preparation strategy, pre-approval, that's where I come in and I help you identify what you're eligible for in terms of financing and purchase power in terms of how much you can afford. And then we'll obviously talk about what's going to be important to you in terms of a loan option moving forward. And then once you finish 1 and 2 and you're comfortable and you're confident and you're ready to hit the search side of this, and you'll be confident and ready to do that. The next slide we're going to talk about is the closing loop. So once you do find that nice house and you put a contract on your home, then it becomes a methodical thing that we will help you with and do and try to reduce the amount of stress that you have in this process, whereby we're going to inspect the home, make sure the home is going to be, doesn't have any structural damage, things of that nature. We're going to have an appraisal done on the home, make sure that you're buying a home for how much it's worth, at least for how much it's worth. And then we're going to transition you into our processing and underwriting department, where they're going to validate all of your employment assets, income, as it relates to that specific property and the program that you select. Once they approve that, then we're going to prepare your loan for closing, and then you go to closing. which we will interchangeably call settlement, where they hand you the keys to your new home. So just as an overview, and when you get to the point where you're ready to make this move, then we're going to talk about these particular things in a lot of detail. But I wanted to give you just a sense as a new buyer what the process is from the beginning stages, where the really high overview to what it's going to take once you find a house to settlement. The next thing I want to talk about is the loan programs. There's generally 4 different agencies out there. There are others we'll talk about a little bit, but FHA is a government-backed loan where it actually is a very flexible type of loan in terms of credit history, in terms of income and asset sourcing and things of that nature. It has a very low down payment threshold, so you can buy a home for as little as 3.5% just on a standard FHA loan. And the biggest drawback to an FHA loan is the mortgage insurance. And I'm not going to spend too much time on mortgage insurance. We're going to talk about that as you get ready to buy a home. But generally speaking, mortgage insurance is an insurance policy like any insurance that doesn't cover you. It actually covers the FHA and it covers the lender in case you were to default on your home, go into a foreclosure. It's an insurance policy that is required if you are putting less than 20% down on your home. The next bucket is the conventional loan. Generally speaking, first-time home buyers are in that 3 to 5% down option. However, the 20% down, as I said, with mortgage insurance, as you can see here, the pros of this is mortgage insurance will eventually go away versus FHA where it's permanent. It doesn't go away. But I wouldn't be too concerned about that because this is likely to be a starter home for you, and the time it would naturally take mortgage insurance to drop off anyway, you may end up being in a situation where you're going to move up into a bigger home. But we'll certainly talk about that as we go through the process of getting you pre-approved and aligning you with the right program. A conventional loan, it doesn't have as flexible criteria in terms of credit. They are a little bit, better when it comes to more down payment. The interest rates can be better. You can eliminate mortgage insurance or reduce mortgage insurance, which we'll talk about a little bit later today. If you're a veteran, then you do have access to veteran financing. The great thing about veteran financing is there is no requirement for a down payment, and they do have very flexible guidelines in terms of credit score. So if you are eligible for VA, great product for you there. The USDA, believe it or not, the U.S. Department of Agriculture does have a loan option if you're looking in a rural type area. So something that is outside of the city limits, generally speaking, farming and so forth. You don't actually have to run a farm for the USDA. It really is a footprint. It's a mapping system that they do. If you are buying in a footprint that is USDA approved, you will be eligible for that particular program. They have, generally speaking, fairly good credit score minimum requirements. They do have a 0 down payment requirement like the VA, but again, you have to find a house that's in a rural area. So let's go ahead and move on to the next slide here. Outside of the standard loan options that we just mentioned, there are state-run programs, in particular for first-time home buyers. I just happened to put the Maryland Mortgage Program on here as just a placeholder to say it doesn't matter if you're in Virginia, Maryland, DC, Rhode Island, wherever you're buying a home, each state has their own version of the Maryland Mortgage Program. So this is just saying that Maryland Mortgage Program, in addition to the financing that you would be eligible for on the first mortgage, then there are state-run programs like the Maryland Mortgage Program that could offer you an additional amount to pay your down payment and or closing costs. And they all vary depending on what you're dealing with. There are income limits. In Virginia, there's an income limit. Any families under 2 people, $186,000 is the total income that you can have for the household. If you're above 2 people in the household, it goes higher and higher. So it really just depends on how many people are going to be in the household moving into the house, I should say. Some of these state programs actually have an option where, as part of this down payment assistance, you could actually pay down student debt instead of using it towards down payment and closing, which is a pretty neat thing that they're doing. Maryland Mortgage Program is one of those products. Outside of the standard programs and the state-run bond programs, there are renovation loans where if you find a house that is, let's call it run down and needs a lot of TLC and maybe $150,000 worth of work that needs to be put into it in order for you to move in, then you could take advantage of the renovation loan. They still have products where you can do as little as 3.5% down. But the idea here is you're going to buy the home as is. Let's say it's a $500,000 home and there's $100,000 worth of work that needs to be done. They're going to look at the improved value of the home. So they're going to take the acquisition costs, which is the cost of the home as is, plus the renovation, and they're going to use that to formulate what that appraised value is. So you're going to be at, let's say, 3.5% of the future value, meaning the improved value of the home. So renovation is really cool if you do find that house that's in the right area and has the right bones, but it needs some renovation. Construction perm, this is another option where you can buy a piece of land and also have the builder build a home on that lot. Those programs do require a little bit more down payment, but I wanted to mention that as an option depending on your situation. So if you really want to live out in a rural area or you find some land somewhere, know that we could help align you with a good builder and you can build on that property. All right. So approval. This is where the rubber meets the road in terms of understanding what you're eligible for. We're looking at 3 pillars: your credit, your income, and your assets. We're looking at your history in credit, we're looking at your ability to repay your loan, and we're looking at what your ability is in terms of down payment and reserves after you go to closing. So let's dig into these pillars a little bit more. So pillar 1, credit strategy and score requirements. Again, FHA, very flexible on the minimum credit score. They do prefer you have 620 or above, which will then level you up into a better interest rate. Conventional 620, they prefer 680 at the highest interest rate and reduced amount of mortgage insurance that you would be required to have. And then VA 580, 620 is preferred, USDA 640, 680 is preferred. But I wanted to put this slide up here because this is the opportunity for us to look at your credit. And what we would do is a soft credit pull, not a hard credit pull. And there's a difference there. You may have read that if you have lenders run your credit, it's going to reduce your credit score. That is the case if you are shopping for a mortgage or a car loan or a credit card, and you're doing that over months at a time. When you're shopping for a mortgage, if we do a hard credit pull, 100 different mortgage companies could run your credit within that 30-day time frame, and all of those inquiries would only count as one inquiry. But mostly what we're doing now is in the early stages is run what's called a soft credit pull. It's like what credit cards are doing to see if they want to send you some junk mail and get you to sign up for their credit card. So we do a similar thing where we're just kind of checking your credit to see where you stand, and then it opens up the opportunity for us to simulate things that we might be able to help you with in terms of paying down debt or indicating, okay, there's some late payments in the areas. This is how we need to handle it. And if we are able to run that simulation that we have for determining what could help improve your score, we can then do a rapid rescore as long as we can get proof of what we're thinking about would increase your credit score. We can send that into the bureaus and have it updated so that we can start working on your loan options based on the new credit scores. But it's very important that you get a really good head start on having us run a soft credit pull, look at your credit and see where we can stand to improve it, because it could mean a better interest rate, lower payment, things of that nature. All right, let's move on here. Okay, income. So generally speaking, most of these loan options require, as an ability to repay, we're looking at not allowing you to have any more than 45% of your current gross household income going to paying all your debts. So student loans, credit cards, the new mortgage payment, doesn't include utilities like water bill, electric bill. That's the other portion of your income that is disposable income to affording those sorts of things. What we're looking at is credit cards, installment loans like student loans and auto loans, things of that nature. So if you, in this case, you have a $5,000 gross monthly income, if we take 45% of that, it leaves you with $2,250. So as long as you don't have more than $2,250 in terms of all your credit cards and other installment loans plus your mortgage, then we will be in a position to check off that list of income, the ability to repay. Some loan options require to have a lower ratio than 45, and some actually allow you to go above 45. As a rule of thumb, we want you to aim for 45 or lower. You may hear out there that it's wise to be at 35%, and there's a difference in what you might be hearing. The 35% or 30% of your income is based on net income. And that's a rule of thumb out there that you'll hear is you shouldn't be spending any more than 30% or 35% of your net income. In the case of qualifying, we're going to take 45% of your income, and that's how we determine what you're qualified for. That income is then going to back us into how much you can afford to buy in terms of the purchase price. And certainly the next thing that comes into play in determining that is the source of down payment. So whatever your access to funds are and what you're really budgeting for the down payment and closing costs on your home, these sources can be from a checking or savings account. They can come from a 401k. You can actually do loans on your 401k. Some of them have home buying options as well. So it'd be good to just check into your 401k to see what is eligible there. Trying not to use that route if we can help it, but in the grand scheme of things, it could be a way for you to buy your first home. We want to make sure that we're turning every stone so that you have a full picture as to what you're eligible for. Stocks, bonds, and cash. Cash could be cash balance in the stock account or investment account. Gifts from a family. All programs allow gifts from a family. Mostly it's going to be your immediate family. So a cousin may not work in some situations, some loan programs. But gifts from family are very key because a lot of first-time home buyers are getting money from family members. If you're not, then we're focused on 1, 2, 3. And sometimes a tax refund can help in terms of, especially we're in this time frame where we're filing taxes and you get a tax refund. It's just like cash. As long as we source it from the tax refund and we can show it in the bank account, then it can be used. What cannot be used is undocumented cash under your mattress, put in a safe, something like that. It has to be deposited in your checking or savings account, and it has to be in your checking and savings account for at least 60 days, or I should say 2 cycles of your bank statement. So when you receive your bank statement, that's one, and then another one. As long as it's been in there for at least 2 of those cycles, then we don't even see it as cash anymore. It's part of your savings and checking, just so you understand that. Okay, let's move on. Oh, one other thing is the underwriters are going to require, underwriter meaning the person who's going to approve your loan. Remember when you got your contract on the home, then we go through this process. Part of that is providing our underwriters your complete profile and letting them make a decision on approval. And they're going to want to paper trail everything. So paper trail meaning the cash that you had under your mattress that you deposited, If it shows up as deposited in those two cycled statements, then the underwriter will say, okay, where did this money come from? And if you can only prove that it came from under your mattress, then it would be excluded from what you're allowed to use. And it's very important to understand the differences there. The gift funds, just so you know, if you can get the gift 2 or 3 months in advance, deposit it in your account, all the better, but it doesn't have to be. If you get the gift right at the time of closing, that's fine. We just have to get a letter from your family member who's gifting you the money to say that they are freely gifting it to you. So there's a couple of options there. You can wait until we get to that point, or you can, if they've already committed that they're going to give you money, then if you have the full 2 checking or savings account cycles, go ahead and get it in there, because that way we won't have to worry about asking your family for documentation and filling out the form. But it's not that hard of a process, just so you know. All right, let's go on to, and this is what I was talking about, the hidden costs. I'm not hiding costs from you, but I want you as a first-time home buyer to understand that the down payment is not the only thing that you need to save for or have in terms of buying your home. There are closing costs. There's prepaid taxes and insurance, things of that nature that we'll talk about just here in a bit. There's mortgage insurance. That could be upfront, that could be monthly. It depends on the situation. You have inspections on the home. You have repairs that you might need to do on the home. And then reserves, cash remaining after closing. We'll talk a little bit more about this, but it's wise to try to keep liquidity there, especially when you're buying your first home. You don't know what you're getting into in terms of repairs and things like that. Not to put any fear in you, but it's always wise to make sure that we're looking at this through the lens of not depleting all your cash if we can help it. All right, going back to what I had said in the beginning, is the monthly payment should not be the only driver to whether or not you're going to buy a home. And I say that loosely because depending on what area you're in and what type of home that you're looking for and what the market is driving, the payment could likely be what it is. And it's just going to be a decision as to whether or not you're comfortable moving forward with that. But if you're in a situation where you're really just trying to put more cash into the down payment so that you can afford a lower payment, you have a lower payment, this is one of the things that a lot of my clients have done. And what I'd like to always help you understand is that this payment might actually be higher than you really want it. But most young families are in their income growth stage. So think about this in terms of once you lock in your payments level, there's some things that can change over the years, like insurance and taxes on the home. But the point is that you don't want to really always focus on the lowest payment, the lowest rate, because liquidity can help in a lot of areas, which we'll talk about here before. But most importantly is an emergency fund, making sure that you at least have 6 to 12 months in an emergency fund. And we talked about the iceberg. There's all these various costs that you want to be considering. But on the flip side of things, there's the opportunity cost. So if you're putting more money in the home because you're trying to drop your payment without looking at this from a long-term perspective, you're trapping that cash in the home and you're not putting it to work for you in other places, which again, we'll talk about. But I wanted to set the stage for that. And just so you know, most people, most first-time home buyers that have access to gift funds and cash are waiting or saving to take this traditional route of putting 20% down to avoid paying private mortgage insurance. A wasted cost in many minds. However, mortgage insurance can afford you to not only buy a home, but also to put money in investments for other things. We're talking about the reserve funds, things like that, but we're also need to think about other things. You have access to the lower down payment options, preserving cash for immediate liquidity and renovations, mid-tier It's a balance between keeping money in savings and keeping the monthly payment low. And this is just like a really at a glance example. If you were in that 20% down scenario, then 10% down, 5% down, as it shows here, you're just leaving more money in liquidity and your payment isn't going up that much, depending on what your budget is and so forth. So these are things that we want to be able to talk about so that you can set yourself up for success, not just in the now to buy your home, but in the future to afford other life expenses, which this is articulating. It really is. You're at your first home at age 25, and a lot of us are thinking in terms of building family, having children, and with children comes expenses like college tuition, but even before that, maybe private school, daycare. There's all kinds of things that we want to make sure that we're paying attention to. The children are eventually going to, at least some of them will eventually want to get married and have their own family. Depending on your philosophy, you may want to pay for weddings. And then we're really focused a lot on retirement, making sure that you have the ample retirement for what you're looking for in life. And I know that when you're younger, this could certainly change over time. However, in your first home scenario, especially if you're considering higher down payments, we want to take a look at the balance between affordability and liquidity, just so that you understand that what we're doing today could help fund or affect these other life events. All right, let's talk about interest rate. We're about 30 minutes in, so this is right on track. We're almost finished with just the information I wanted to share with you today, but I also want to leave it up for questions because it's very hard to pile everything about mortgages and everything about buying a home into 1 hour session, and also being able to ask questions and so forth. So interest rates. As you can see, this isn't a real representation of what's been going on, but it's pretty close. You think about a roller coaster. It's been a big roller coaster. I don't want to spend too much time on this and dive into this too deeply. Just know that I'm always watching this. I'm always listening to the experts and trying to understand what's happening with the market. And right now, if you look over here, this is a good representation as to where we were. Maybe let's call this 3, 4, 5%. We're now in that 6%, 6.25% range. So it's gone up quite a bit. However, what we anticipate and what we're hearing is that rates will eventually come down. And if you look at history, anytime that we had this really steep downward trend where the Federal Reserve was lowering interest rates drastically to try to stimulate the market or make the market go again or make the market more robust, they were driving down rates to have all of us purchase more things. They did it so drastically, they left it down so long, and then they drastically corrected and tried to drive it up to stop the spending, to control inflation. Anytime you've seen this in history where that sort of effect happens, there's always a forward correction. So what we're thinking, and the administration is actually really focused on lowering rates. What the experts are saying, what we're hearing, is that rates will start to trend down towards the end of this year into next year, likely getting to that point where it's around low 5%, 5.25%. What that means to you. If you are purchasing now, as long as it's affordable and it's comfortable, and I know this is cliche and I hate to use this, but you may have heard out there on social media, marry the house, date the rate. It's been overused, but the reality is you are marrying the house and you should be dating the rate, because rates do go up and down, and over history, they always have these ebbs and flows. As long as it's affordable, as long as you can make sense of doing a purchase now versus waiting, you're jumping in with home values. And another historical thing is that values generally will go up 3% on average nationally on a yearly basis. Yes, there are ebbs and flows, and there have been big dips and increases and decreases. But generally speaking, if you're holding your home for 5 to 10 years, you're likely going to be in that 3% average appreciation. So the sooner you get started, the more opportunity you're going to have to build that kind of equity in your home, that kind of wealth in your house. I know, marry the house, date the rate, because even at this point, there's a better and even chance that rates will come down. And at that point, you'll have an opportunity to work with me again, and we can do what's called a refinance. And that's really just redoing your mortgage with the lower rate. I just want to make sure you understood that. All right, let's go on. As I've said in the entire presentation, buying your home is a big financial decision. It's not a transaction. Don't focus on just the rate and just the payment. Look at this from a strategic standpoint, how it's going to, what you're doing, not just for the home, but for your life, other life expenses and things like that. So I want to make sure that we're paying close attention to that. All right, before I open it up to questions, I want to share a couple of examples here using a tool that I developed. As I said, I'm the founder of Wisely. It's short for Mortgage Wisely, and it really just is what it is. It's helping you make a more informed financial decision about buying a home. And I wanted to share with you a couple of options, which I'll also send to you so that you can have it to play with and look through. But it'll also give me a way to help you understand like all the components that are involved in your down payment, your closing costs. So when we're getting you to a point where we can start to dig in and understand what your options are and really understand based on your particular goals, not just with the home, but life goals, we can put together a presentation that compares the different options that you might be eligible for. In this particular case, this is a buyer who has 20% down. They've saved it on their own, and or they're getting a gift from a family member. And we want to make sure that we're understanding what our options are. Should we put all of that money into the home, or should we finance more and then keep that money for other purposes? So in this case, as you can see, the purchase price is $649,900, and the cash to close between down payment and closing costs, which we'll get to at the bottom here, in the 5% down is $51,740 versus $148,617. If you had, in this case, the buyer had $200,000 to work with, the 5% down will leave $148,260 in liquidity, where they could use it and potentially connect with a financial planner and invest that money for other things. In the case of the 20% down, most of it's going in the home, so you're left with $51,383. So when we go to the analyze side, if you plan to own the property for 10 years, and let's say in this case, the buyer said when they do invest money, they expect to get a 7% rate of return on those investments, you can clearly see that by putting the additional amount in an investment account versus putting it in the home, between the equity that they would build in the house, and that's equity, the down payment, plus it's monthly amounts that you're depositing in your home when you make a payment, because your payment is comprised of part principal and part interest to pay back the loan. And the principal is what you're depositing in your equity to build more equity. So it's for savings account in that regard. But that cash that you were able to leave in investments, the $148,000 over 10 years at 7% grows to $297,952. So you can see where if you were planning to have children and it was going to, you're going to have other expenses, this could accumulate more liquidity for those reasons. Versus if you put the money in the home, it's locked in the home, and really the only way to get it back is to do a refinance, which could be more costly in order to get that money back. So that's the other thing, is once it's in the home, it's not as easy to get it back. So in this case, $103,000 would be in the investment account. Whether or not that's sufficient enough to continuously build up your liquidity for other life events really is a situation by situation. So that's really what we would do, is analyze what you have, what your goals are, and help you make a more informed financial decision. The other one I wanted to show you is a lower down payment option. There is opportunity if your income is, if you don't exceed the income limit, you could potentially, like in the state of Virginia, the maximum amount that they would allow you to purchase is $800,000 in the state of Virginia. But in this case, you would have only $1,776 in cash out of pocket. And that's because when we go down a little bit further, I'm going to show you that there's a first mortgage that would give you $772,000. That's 96.5% of the $800,000. It would be a government loan in this scenario. FHA is the loan that this is driven off of. The interest rate's a little higher than the conventional option that requires a little more down payment, but it also has the ability to finance even more. So you can finance an additional $48,000, a little bit higher rate. But the point is that for not that much more per month, and I say not that much more, it could mean a lot to you, it could mean very little to you. And I'm just wanting to share examples here so that you understand what's out there for you. So between your closing costs and your prepaid items, plus your down payment, you wouldn't have any. And in fact, this would allow you to actually get money back because you're able to essentially finance your closing costs. So that's why you're only left with about $1,000, about $2,000 out of pocket. Versus if you did the conventional loan, you're looking at more $49,000 out of pocket. But again, it's the analyzing that we want to make sure that we're paying attention to. It really just depends on the scenario, but the more you can keep in liquidity sometimes will help. But if you don't need the liquidity and you have a source for building up liquidity for life events down the line, then, and you want to try to drive your payment down and pay off your loan quicker, we'll run those scenarios too. Like I said, it depends on your goal. I'm not here to say that you should always put less down. I'm here to say for most first-time home buyers, you want to consider these things, but it's not the be-all, end-all. It really just depends on your situation. And it depends on really your comfort level. I'm only here to help you make a more informed decision. I'm only trying to say, consider these options, because most information you'll hear out there is going to tell you to put all your money in the home, get the lowest rate, get the lowest payment. But that is not necessarily what might set you up for future success.